Welcome to The Explainer. If you hold crypto, chances are it's just sitting there. But what if it could be out there working for you? What if it could be generating returns that make your traditional savings account look like a relic from the past? Today, we're diving deep into the fascinating and, kind of risky world of DeFi yield farming. It really all boils down to this one single powerful question. Instead of relying on the old guard, the traditional financial institutions, what if you, yes you, could step into that role yourself? And look, this isn't just some hypothetical question, it's the absolute core idea that drives this whole revolution we call decentralized finance, or DeFi.
And here's the promise, right here, in a nutshell. On one side, you have the system we all grew up with. Banks take our deposits, they lend them out, and they give us back just a tiny, tiny fraction of the profits. We're talking often less than 1%. But on the other side, DeFi yield farming just cuts out the middleman entirely. You provide the capital, so you get the rewards. Simple as that.
So what does this big idea really look like when the rubber meets the road? Well, the scale of it all might actually blow you away. And we're not talking about some tiny, niche corner of the internet. At its peak, the total value locked, that's the total amount of money people have deposited into these DeFi protocols, has hit around $120 billion. That's not just a little experiment. It's a rapidly expanding financial ecosystem that's attracting some serious capital, and with it, a whole lot of trust.
Okay, so let's get into the real mechanics of it. How does putting your crypto to work actually generate a yield? It's all about one key concept: providing liquidity.
At the very heart of yield farming, you'll find the liquidity pool. Now, the easiest way to think about this is like a big community-owned pot of money, or a community currency exchange. Instead of a bank or a brokerage matching buyers and sellers, users like you and me lock our tokens together into these pools, creating this big, decentralized reserve that anyone can then tap into to make trades.
So, as a liquidity provider, or LP as you'll hear it called, the process is pretty straightforward. You deposit a pair of tokens, let's say some ETH and a stablecoin like USDC. Your deposit then helps make trades happen smoothly for other people. And for every single trade that uses your liquidity, you earn a tiny piece of the fee. It's a direct reward paid to you for helping the system work.
But wait a second, you might be thinking, how does this all work without a person, a company, a someone in charge? Well, the magic ingredient here is the smart contract. You can think of it as the neutral, incorruptible middleman. It's just a piece of code living on the blockchain that follows a set of rules, period. It automatically executes trades, collects the fees, and pays out the earnings. No bank, no paperwork, no human error, just code.
Okay, now that you get the basic mechanics, the next logical question is, how do you actually get started? Because not all yield farming is created equal. There are different strategies out there, and each one has its own unique balance of risk and reward.
Let's start by looking at the two main ways people get their feet wet. First, you can be a liquidity provider. This is where you're chasing those potentially higher rewards from trading fees, but you're also taking on a very specific risk we're going to break down in a minute called impermanent loss. Or you could go the staking route. This is often more stable, more predictable, since you're helping secure a network. The trade-off? Your funds are locked up and you're still exposed to the price of that token going up or down.
And for those who are a bit more adventurous, there are even more advanced strategies. You could use leverage, which means borrowing money to amplify your returns. But remember, that also amplifies your risk big time. There's something called liquid staking, which is clever and lets you stake your tokens but gives you back another token you can use, keeping your capital flexible. And then there are yield aggregators, which are kind of like robo-advisors for DeFi. They automatically hunt for the best returns for you, so it's a much more hands-off approach.
All right, those high returns, the different strategies, it all sounds pretty amazing, right? But now we need to have a serious talk about the other side of the coin, the risks. This is not a risk-free game, not by a long shot, and really understanding the potential downsides is absolutely crucial. First off, let's clear up something that trips a lot of people up: APR versus APY. The APR, or annual percentage rate, is just the simple interest. But APY, annual percentage yield, that's where the magic happens. It includes the power of compounding.
which means you're reinvesting your earnings to make even more earnings. That little difference means a 20% APR could actually turn into a 22 or even 23% APY if you're compounding daily. Knowing which one you're looking at is key to understanding what you might actually earn.
This chart does a great job of laying out that risk-reward spectrum. Over on the left, you've got staking. It's often seen as the baseline. It's simpler, with returns that are usually more predictable. As you move over to liquidity providing, the potential rewards start to tick up, but so do the complexities and risks. And then way over on the far right, you have leverage farming. It offers the highest potential gains, for sure, but it also carries the severe risk of liquidation, where you could lose everything you put in.
So let's finally tackle that key risk we mentioned, impermanent loss. What on earth is it? Well, it happens when the prices of the two tokens you deposited in a pool start to move apart from each other. The smart contract, that automated middleman, has to rebalance your holdings to keep the pool 50-50 in value. The result? You can end up with less total value than if you had just held on to those original tokens in your wallet. It's called impermanent because the loss isn't locked in until you actually withdraw your funds. But if you pull them out at the wrong time, that loss becomes very, very permanent.
So to quickly recap, here are the 3 big risks to always keep in the front of your mind. Number 1, smart contract bugs. The code could have a flaw. Your best defense here is to stick with well-known, audited platforms. Number 2, good old-fashioned market volatility. The price of crypto can go down fast. And number 3, impermanent loss, which, as we just saw, is a very specific and real risk for anyone providing liquidity.
Now, despite all those risks, this space is evolving at an incredible speed to become safer, cheaper, and way more powerful. So, let's look ahead. What's next for yield farming?
A massive game changer has been the rise of what we call Layer 2 solutions. Think of these as express lanes that run on top of the main blockchains like Ethereum. The result? Transactions become dramatically faster and cheaper. And what this really means is that yield farming is no longer just for the whales. It's becoming accessible to everyday users who were previously priced out by those crazy high gas fees.
Another really fascinating trend is the integration of real-world assets, or RWAs. Just imagine this, earning a yield from a pool that's actually backed by tokenized real estate or corporate bonds. This is a huge deal. It's bringing a whole new level of stability and is starting to build a bridge between the world of traditional finance and this new decentralized frontier.
And the innovation just doesn't stop there. We're seeing AI-driven platforms that optimize your strategies for you automatically. Cross-chain farming is becoming a thing, letting you hop between different blockchains to find the best yield. There's even decentralized insurance to help you protect against some of those risks we talked about. And maybe most important of all, there's a real shift towards building more realistic, more sustainable yields for the long-term health of the entire ecosystem.
So when you put it all together, what does it all mean? I think this quote just captures it perfectly. DeFi is about so much more than just a new way to make money. It's about completely rethinking the foundations of finance to build a more open, more accessible system for everyone. And it really leaves us with one final question. What role will you play in it? Thanks for joining me on this explainer.